Welcome to the deep dive. Today we're digging into Hindalco Industries Limited, specifically their Q2 FY26 performance. So that's the quarter and half year ending September 30, 2025.
Right. And it's more than just numbers, isn't it? It's
Yeah.
really, well, a tale of two very different stories within one company.
Absolutely. We've got the financial reports, investor decks, and crucially, that detailed earnings call from Novelis, their big North American arm.
Yeah, that novelist transcript was key.
Yeah.
Our mission here is to figure out how they pulled off such strong consolidated results when, honestly, the global side, Novelis, was getting hammered by some major external shocks.
That's the fascinating part we found. You've got the India operations acting as this incredibly strong anchor, posting record results, record margins.
Really propping things up.
Exactly. Strong enough to offset these unexpected crises in the U.S. and global trade issues.
And if you just glance at the top line, it looks great. Consolidated revenue, 56,058 crore. That's up a solid 13% year over year.
And net profit, PT, jumped 21% year over year to 4,741 crore. Big numbers.
Huge numbers. But you really need to unpack where that profit came from. Like you said, the strength in India was basically masking a much rougher ride overseas for Novelis.
And what really stands out is how they absorbed those hits without blowing up their balance sheet. Consolidated EBITDA was 9,684 crore.
Too good, yeah.
But maybe more importantly, look at the discipline on debt. Consolidated net debt to EBITDA came in at 1.23x.
Right. Which is only slightly up from 1.19x the year before.
Yeah.
Staying that close to 1.0x, especially with massive projects underway.
It shows leverage is a top priority for them, almost above everything else.
And they need that focus, especially given the backdrop they themselves pointed out. They see global growth kind of slowing down, 3.3% in 24, maybe slipping to 3.2% in 25.
But India, as you said, is the bright spot. The RBI thinks India's GDP growth could hit 6.8% in FY26. That's up from 6.5%.
Driven by strong domestic demand, yeah. They mentioned a record, 6 trillion rupees in festive season retail spending expected. India is not just stable, it's actually picking up steam.
Okay, let's pivot to Novelis then, because, wow, that's where all the action, the drama, really happened this quarter.
Yeah, it's their biggest piece, and Q2 threw two massive curveballs at them. Tariffs and, well, a major fire.
Despite all that chaos, the underlying operations seem pretty resilient.
They do. Shipments were basically flat compared to last year, 941 kilotons. Revenue actually climbed 10% to $4.7 billion, mostly thanks to higher aluminum prices.
But the headline, adjusted EBITDA number, was down 9% to $422 million.
It was. But here's the kicker, the aha moment from their earnings call, the tariff impact.
Right.
That reported adjusted EBITDA per ton was $448.
Okay.
But they specifically called that a net negative tariff hit of $54 million.
$54 million, that's huge.
It is. And if you pull that number out, the underlying EBITDA per ton jumps to 506 ton.
So operationally, they actually beat their key target. They cleared the $500 per ton hurdle.
Exactly. It proves the core business, the cost structure, the efficiency, it's all working really well. It's just, geopolitical noise masking it.
And they're trying to make that core even stronger, right, with cost cuts.
Yeah, they're speeding up their cost-cutting plan. Now aiming for savings over $125 million run rate by the end of this fiscal year.
Which is part of that bigger, longer-term goal.
Right, the 3-year plan to permanently slash $300 million from their cost base by the end of FY28. They're serious about efficiency.
Okay, let's talk about the other major shock. The Oswego fire. Happened in September, contained to the hot mill, thankfully. But what's the financial damage?
It's a significant, immediate cash squeeze. They're estimating a total negative hit to free cash flow in the second half of FY26, between $550 and $650 million.
Wow, $500 million plus. Where does most of that pain hit?
The adjusted EBITDA impact, about $100 million to $150 million, is expected mostly in Q3, while the mill is down.
So $500 million in cash they suddenly need to find. They expect the hot mill back online in December, which sounds pretty quick, but how do they manage the money side without letting debt spiral?
Well, they can't let it spiral. And this is where that balance sheet focus comes back in. They expect to get 70% to 80% of the loss back from insurance.
Okay.
But that money won't show up until later, probably sometime in FY27.
So there's a timing gap, a
Okay.
big one.
Exactly. So to plug that immediate hole and keep Novelis's own leverage ratios in check, the parent company, Hindalco, is stepping in. They're planning a $750 million equity infusion into Novelis.
Where's that money coming from?
It's actually debt being raised one level up at the AV Minerals level.
Mm-hmm.
It's basically Hindalco borrowing the money to inject as equity into Novelis.
Ah, clever. So it supports Novelis's liquidity and capex without messing up Novelis's own debt numbers directly because of the fire.
Yeah.
Classic parent company support.
Textbook move. Shows strong backing and keeps the Novelis balance sheet looking cleaner through this disruption.
It shows serious commitment, definitely. But it kind of hinges on that insurance recovery, doesn't it? If
Yeah.
that 70–80% gets delayed or comes in lower, the $750 million cover everything.
It does seem like they're counting on things going smoothly with the insurance payout and the restart timeline. It sets a high bar for execution.
And speaking of high bars and big money, let's talk Bay Minette, the huge Alabama greenfield project. Still moving forward, but the price tag, it's gone up.
Significantly, the latest estimate for the total project cost is now around $5 billion.
$5 billion. That's a massive number. How are they justifying that increase? Does the original business case still hold water?
Yeah, they broke down the reasons on the call. About half of the increase is just inflation tariffs, labor costs are up, competition for contractors.
Okay, that makes sense.
Another, say, 30–40% is down to sorting out complex engineering details and finalizing packages as they get closer to completion.
And the rest.
The rest is about making the site ready for future expansions down the road, future-proofing it.
So even with the cost blowing out to $5 billion, they still think the project makes sense financially.
They do. They stress that the strategic rationale is unchanged. The cold mill commissioning is actually coming up next quarter, and the whole thing should be up and running in the second half of 2026.
And the returns.
The IRR, the internal rate of return, is now slightly below double digits, they admitted. But, importantly, it's still above their cost of capital. And they were very firm about reaffirming that long-term goal of hitting over $1,000 EBITDA per ton from Bay Minette once it's ramped. Long game.
Okay. One last thing on Novelis before we switch gears. They're idling a line in China.
Yeah, one of the two cash lines seems like a response to maybe slower uptake of aluminum in Chinese EVs than expected, plus more competition over there. Quick adjustment.
Smart move to manage capacity. Okay, let's flip back to India, where honestly the story was consistently positive. Hindalco India really carried the quarter.
Absolutely. The India segment EBITDA was up 15% year-over-year, hit 5,419 crore. Just stellar performance.
And the upstream aluminium business, I mean, the margins they achieved were just world-class.
45% EBITDA margin. Just think about that. Industry best. Their upstream EBITDA itself was 4,524 crore, up 22%. And EBITDA per ton hit 1,521 RALs. Shipments grew too, up 4%.
And they're doubling down on that strength, aren't they, with the new Aditya expansion?
Yeah, phase 2 of the Aditya aluminum expansion. It's a big one, over 10,000 crore investment to add 193 kilotons in capacity, scheduled for FY29.
And the goal there is explicit. Stay super competitive on cost.
Exactly. Keep themselves in the first decile of the global aluminum cost curve. Basically be among the world's 10% cheapest producers. That's their edge.
And are they managing price risk around that? Hedging in?
They are. For Q3 FY26, they're 31% hedged around $2,700 a ton. And for Q4, it's 49% hedged near $2,760 a ton, locking in some pretty favorable prices there.
That upstream strength clearly flowed through to downstream aluminium, too. Records there as well.
All-time records. Quarterly EBITDA hit 661 crore. That's up an incredible 69% year-over-year.
Wow.
Driven by higher shipments, up 10%, and a better product mix. EBITDA per ton also hit a record $265, up nearly 50%.
And they have big ambitions for downstream, right?
Huge. They're targeting a 4x increase in aluminium downstream EBITDA by FY30. It's a major growth pillar for them.
Okay, rounding out the India picture, copper. That market faced some serious headwinds with treatment charges, didn't it?
Oh, brutal headwinds. The benchmark TCRCs, that's the fee smelters get for processing copper concentrate, just collapsed. For 2025, the benchmark is set at 5.45 cents per pound.
Which is down from what?
Down from 20.5 cents per pound in 2024. That's a 73% drop. Just wiped out a huge chunk of smelter revenue across the industry.
73%. How did Hindalco's copper business even manage to stay resilient with that kind of pressure? Their EBITDA was still pretty solid at 634 crore.
It was. The secret weapon was sulfuric acid.
The byproduct.
Exactly.
Yeah.
Because they're so integrated, strong demand and pricing for sulfuric acid, which is used a lot in fertilizers, helped offset that massive drop in the TCRCs. It's that integrated model providing a sort of natural hedge.
That's a fantastic example of resilience through integration. And they're expanding in copper, too.
Yep, the new copper tubes project is nearing commissioning, and the copper recycling facility is on track for FY27. building out capacity and focusing on circularity.
Which brings us neatly to sustainability and operational stuff, worth touching on briefly.
Absolutely, they showed good progress. Circularity, 78% of waste recycled or reused in Q2, up from 69% last year. Water consumption down 2, thanks to new recycling systems.
And I thought this was interesting, that safety policy where unit heads have to do night duty rounds.
Yeah, the night duty officer role once every 10 days. It's about ensuring safety commitment isn't just talk, it's visible on-the-ground leadership.
Sends a strong message.
Definitely. Plus, they planted a lot of trees, nearly 4.5 lakh saplings in the first half, including that green wall at Aditya Aluminium. And renewable energy is scaling fast, aiming for about 522 milliW capacity by the end of FY26, up from 292 milliW now.
Okay, so let's wrap this up. This deep dive into Hindalco's Q2 really shows a company leveraging its core Indian strength, particularly in aluminium,
Both upstream and downstream.
to power through some really severe external shocks hitting novelties, the tariffs, that Oswego fire, the Bay Minette cost jump.
And it all comes back to that capital allocation commitment. Despite needing, what, $5 billion for Bay Minette, plus big money for the Aditya expansion in India.
Yeah, huge investments.
They've drawn a very clear line. Keep consolidated net debt EBITDA below 2.0x through this whole CapEx cycle, all the way to FY29.
It's a bold target. And maybe that's the final thought to leave people with. It feels like a high-wire act, doesn't it?
How so?
Well, you've got that unexpected $500 million plus cash hole from the Oswego fire. You've got the $5 billion Bay Minette bill. Maintaining that tight leverage below 2.0x relies so heavily on perfect execution, on that insurance money coming through quickly.
Right, a lot has to go right.
Exactly. What happens if global demand wobbles more, or prices shift again, or if there's another unforeseen event, or even if just that insurance recovery timeline slips? That sub 2.0x target makes operational perfection pretty much non-negotiable for the next few years. It's a huge challenge they've set themselves.